15 years. That's how many contribution years you have left if you're 50 today. Then about 30 years of retirement to account for. On a $300,000 portfolio, a 1% difference in annual return over 15 years is about $120,000. That's an expensive car, a nice kitchen remodel, or 4 years of your retirement income. In this video, I'm comparing SCHD, VYM, and JEPI on total return income, volatility, and taxes. Then I'm splitting the 50s into 3 buckets based on what you've actually got saved, whether it's under 250K, between 250 to 750,000, or over 750,000. Because one of these 3 doesn't make sense to own at 50 and is much better to own at 64. Let's get into it. Usually these 3 get lumped together as dividend ETFs, but that is just not true. SCHD is Schwab's US Dividend Equity ETF, about 100 stocks, screened hard for quality. They have 10 straight years of dividends, strong cash flow against debt, high return on equity, launched in October 2011, pays quarterly, and the expense ratio is 0.06%. VYM is Vanguard's high dividend yield ETF, roughly 550 stocks. It takes the top half of the US market by yield and weights it by market cap. Almost no quality screen, just a lot of dividend payers. Launched November 2006 and pays quarterly. The expense ratio just got updated this year in 2026, and it went from 0.06% down to 0.04%. JEPI is different in kind. It's JP Morgan's Equity Premium Income ETF. Launched May 2020. About 80% of it is a hand-picked basket of low volatility S&P 500 stocks. The other 20% is equity-linked notes, which sell call options on the S&P 500, and then they collect the premium. That option premium is where most of the yield comes from. You are not being paid by companies raising their dividends. You are being paid to sell away your upside. It costs 35 basis points, roughly 6 to 7 times what the other 2 charge. So the lineup is clean. JEPI pays the most today and grows the least. SCHD pays less today and raises it fastest. VYM sits in the middle and owns the most companies. I would love to give you a 10-year chart on all 3, but because JEPI has only existed since May of 2020, I can't. So we compare the window all 3 actually lived through. Which fund fits you comes down to how much risk you actually carry, and that's the whole reason I run 3 separate portfolios inside the Boring Money Club on Patreon. A conservative, a moderate, and an aggressive, all built from just 3 ETFs. I keep them updated with performance, risk metrics, all in a monthly update, and I post portfolio case studies on why a simple 3-fund setup holds up better than a complicated one. Link is in the description. Since JEPI's launch with distributions reinvested, SCHD returned about 15.57% a year, VYM about 15.5%, JEPI about 11%. The reason JEPI trails in a rising market is the strategy working as designed. When you sell a call option, you keep the premium and you give up the gains above the strike price. In a year the S&P 500 runs 25%, JEPI hands a lot of that away. All 3 trailed the S&P 500 over this stretch. I'm not going to pretend to you otherwise. What they buy you is a paycheck, and that's what starts to matter as you are in or nearing retirement. Now the part that makes JEPI famous. SCHD yields about 3.3%, VYM about 2.3%, JEPI about 8.2%. On $100,000, that's roughly $3,300 a year from SCHD, $2,300 from VYM, and $8,200 from JEPI. And JEPI pays monthly as well, not quarterly, which lines up with how bills actually arrive. That check is not fixed. Option premiums rise when volatility rises, so JEPI pays more in scary markets and less in calm ones. Its monthly distribution has ranged from about 33 cents to about 54 cents per share. If you're budgeting off the highest month you've ever received, you're going to be disappointed eventually. Here's the split that decides the whole video. SCHD has grown its dividend at roughly 8 to 11% a year, depending on the time frame. VYM at about 7 to 10%. JEPI has no dividend growth engine at all. Its payout tracks volatility, not company earnings. So there's no built-in raise and no reason to expect one. On fees, SCHD is about 60 bucks a year. VYM will run you about 40 on 100 grand. JEPI runs about $350 on 100,000. You're paying for active management and an options overlay, so it isn't outrageous, but it also isn't free. In your 30s, volatility is noise. In your 50s, it's a different story. You no longer have 20 years to wait out a bad decade if you start drawing on your portfolio at the normal times in retirement. In 2022, when the S&P 500 fell about 18%, SCHD was down roughly 17, VYM about 16, and JEPI about 14. JEPI held up best, and there are two reasons. It owns deliberately low volatility stocks, and the option premiums keep landing while everything falls. The catch shows up on the way back. Those same call options that cushion the fall also cap the recovery. JEPI goes down less and comes back slower. If you need the pile to heal, that's a problem. If you need the check to keep arriving, it isn't. One of these three has lived through 2008. VYM launched in 2006 and fell about 55% peak to trough in the financial crisis. SCHD launched in 2011 and JEPI in 2020. So neither has ever seen a real credit crisis with actual money in it. VYM's crisis is the useful lesson. High yield screens load up on financials, and in 2008, the banks were the epicenter. They cut dividends by the truckload. None of these three is a bond or a savings account. Any of them can fall 30% while paying you less than it did the year before. This section matters more than any performance chart, and it's where JEPI videos stay quiet. SCHD and VYM pay mostly qualified dividends, taxed at the long-term capital gains rate. That's 0%, 15%, or 20% depending on your taxable income. And plenty of retirees land in the 0% bracket. JEPI is split. The stock portion pays qualified dividends. The option premium from those equity-linked notes is taxed as ordinary income at your regular tax rate. Run that at 55, still working, still in a high bracket. The same gross income keeps meaningfully less of itself in JEPI than in SCHD, and you didn't get to choose when it arrived. It shows up monthly whether you needed it or not. I'm not a CPA, and this isn't tax advice, but the rule of thumb almost everyone lands on is the same. JEPI belongs in a tax-sheltered account. In a ROTH or a traditional IRA, the whole issue disappears and JEPI becomes a much better fund. It stacks into Social Security taxation, Medicare IRMA surcharges, and ACA subsidies if you retire before 65. So holding it in a taxable account can raise costs that have nothing to do with the fund. The right fund depends almost entirely on one number, what you've got saved right now. Let's start off with the first bucket, under $250,000. Grow $200,000 for 15 years at 8%, and you land around $634,000. Catch-up contributions can push that higher. At a 4% withdrawal rate, $634,000 is about $25,000 a year plus Social Security. Your problem isn't income, it's the size of the pile. And JEPI is the wrong tool for that because you'd be capping your upside during the exact 15 years you need the upside most. Paying ordinary income tax on distributions, you're just going to reinvest. Investors in this bucket usually keep a broad market or growth core doing the heavy lifting. If they want a dividend sleeve, SCHD is the one that fits because its payout compounds. High yield today does nothing for you when you're reinvesting all of it anyways. Bucket 2, 250K to 750K. $500,000 at 8% for 15 years is roughly 1.58 million. You're on a real path, you're not there yet, and you can't absorb a lost decade either. This again is the SCHD and VYM bucket. A growth core plus a dividend sleeve of maybe 20 to 30% that grows as the date gets closer. SCHD if you want the payout raising itself. VYM if you'd rather own 550 companies than 100. Plenty of people actually own both, so no harm done there. JEPI here could show up as a small sleeve inside the IRA, and usually only in the last few years before you retire. Some investors start easing into it around 60, so the income stream is already running when they need it. Bucket 3, 750,000 and above. 750,000 at 8% for 15 years is about $2.4 million. At a 4% withdrawal, roughly $95,000 a year before Social Security. If that covers your life, the game totally changes. Your job stops being get more and starts being don't lose it and don't panic. Capped upside costs you almost nothing when you've already won, and a monthly check that arrives during a bear market is actually worth a lot. This is where JEPI earns its place. Highest income of the three, monthly distributions, lowest drawdown, held in the IRA where the tax problem vanishes. SCHD alongside it for the raise that keeps up with inflation because JEPI won't. VYM if you want the broadest diversification and the only real 2008 track record in the group. My opinion, clearly labeled, I'd own SCHD through my 50s and not touch JEPI until I could see the withdrawal date, and then only inside an IRA. I want the payout compounding while I still have a runway, and I want maximum cash flow when the runway is gone. That's how I think about my own situation. Yours has different numbers in it. Bottom line, SCHD is the one that raises your paycheck, best when you still have a decade of runway. VYM is the boring diversified middle and the only one that walked through 2008 with real money in it. JEPI is maximum income now with capped upside, an ordinary income tax bill, and a place in your IRA when you're close enough to see the finish line. Getting that order right matters more than just picking a winner. Tell me your bucket in the comments. Which one are you in and which funds do you currently have in them? If this helped, subscribe for more no-hype investing. My monthly updates and my actual portfolios are in the Boring Money Club on Patreon. Link is in the description. And if you want the other side of this decision, watch my VOO versus SCHD breakdown right here. I'll see you in the next one.